combine the strategies of privatized banking with turnkey real estate so we get a real example of how this will work. What you're looking at right here is a whole life insurance policy. There's many different types, but this is a whole life policy. Important to note that. With the whole life policy, there's really two main columns that you need to be tracking. On the left-hand side, we have guaranteed, and then on the right-hand side, you see non-guaranteed. The first two columns, very self-explanatory. That's my age and then the year of the given policy. The first column is the contract premium. That is how much capital that you're putting in there per year. You'll note there that that first year is bigger than all the other ones. That's because you're allowed a one-time lump sum to actually fund these policies. So what I did personally with my numbers, we got a lot of military people in the chat. I took some contribution dollars from my Roth IRA and my TSP, government 401k, and that's what I used as my one-time lump sum to actually fund these things. So being crystal clear here, my tax bill for that move was $0 because I did a rollover and took some contribution dollars. So instead of waiting for that capital to hit when I'm 59, 65, it's working for me now. So that's what I did for my one-time lump sum. And then the money that I was routing towards a high yield savings account, I started to capture inside of these policies. And note here, your numbers can be different. I have clients that put in $200 a month. I know people that put in $20,000 a month. It's all dependent on what you're trying to do and when you are trying to get there. The next column here is the guaranteed cash value. So crystal clear, this is the essentially worst case scenario value that you will have access to inside your policy. And you could use that to go buy assets. So you have a contract with the life insurance company and you are guaranteed a rate of return. So you could point your finger on this contract and say at 36, I will have X amount of money in my policy. There are certainties and guarantees baked into this thing. And also because you have a life insurance contract, you are also guaranteed a death benefit that is paid upon your death or whoever the insured is. I don't plan on dying on anytime soon. I'm sure you don't either, but I'm sure you know someone with cancer. So life could get real very, very quickly, and you could access a portion of that death benefit early if something were to happen to you. But that's really not really why I'm using it or why I care about the death benefit. If you guys know me and my story, what I'm doing is I'm taking my death benefits and putting them inside of a trust. I control the rules and regulations around that trust, which are helping with some of my philanthropic goals in both the martial arts space and then the disabled community space too. So, peeling back the layers a little bit, like truly, I feel like we are at a time and place where corporations and governments are not going to save us. Newsflash, right? But people are going to save people. You could structure your capital to help fund some of those passions that you have or protect your family. And truly, I feel like we are at a time and place in history where people are going to have to step up to the plate and start doing this. And that is the mission behind everything that I'm doing, is that method. And to encapsulate that, that is called the Rockefeller method. So that is the guaranteed side. Jumping over to the non-guaranteed side, the main talking point here is dividends. It's very important to note that dividends are not guaranteed, but in a big but, they've been paid on time with very little variance for the past 2 centuries. A couple of little fun facts I threw out here is life insurance companies have been around longer than banks. They predate the tax code, and banks are the largest owners of whole life insurance, which blew my mind. But if you look at what a bank does, they are in the business of lending money to make money. If you can lend money and a portion of your return is guaranteed, that's very advantageous. So that is why banks own so much. And then the next column here is the net cash value. And all that is the cash value when those dividends are reinvested inside of the policy. So you guys all know how compounded interest works, but just to highlight the power here, if we go down to my age 62, we have $1.6 million versus $3.6 million in cash value that you would have access to inside your policy. And then finally, we have our death benefit, which is just the death benefit with the incorporation of those dividends once they're inside of the policy. I'll pause here and really highlight the fact that this is not a normal whole life policy. And that is where the waters start to get very convoluted inside of the whole life space, our insurance space as a whole. I heard about this concept about 5-6 years ago, immediately wrote it off as a scam. And honestly, it's kind of for good reason too. Life insurance in and of itself is not a scam, but the way it's sold is. And I want to highlight here, what you're looking at is not a normal life insurance product. What is normal, what would be normal, is you would see a zero in this net cash value for the first 1 to 5 years. So if my intent is to go buy assets as quickly as I can, and I can't access my money for the first 1 to 5 years, then no shit, you wouldn't use that design, right? But that's where things get really convoluted, is because that is what's normal. And finance is really similar to politics. Once we get an idea in our head, things tend to get really tribal, and it could be impossible to communicate and communicate different ideas. I know that because it happened to me. It took about 30 books and 1,000 hours of conversations for me to get to this point and actually get through my head. But yeah, I just wanted to highlight that this is not a normal policy that you're looking at. This is a high cash value design with the intent to go buy assets as quickly as you can. And 10 minutes left here. I'll just walk through some numbers of what I did here first year and how you could combine something that Marina's doing with what I'm doing on the whole life side. And we'll just use my, no shit numbers here. So you'll note there again, first year, I put in 170K and I had access to about 150K. Again, not normal at all. This is very high efficiency. With that 150, I deployed about 120. With that 120, I went to go purchase some cash flow in real estate in the Midwest. Those properties generate cash flow. That cash flow pays off the interest that I pay to the insurance company. But here is the main kicker. When I deployed that 120, I am still gaining interest and dividends tax-free at 150. I'm applying leverage. I'm using life insurance company money to go buy that asset while my money remains intact and continues to grow tax-free. Walking through that example again, to drive it home, let's go down to policy age 16. We have $1.2 million of cash value. If I extract 600K to go do that 333 deal, I still gain interest and dividends tax-free at $1.2 million. Again, I'm using debt, cheap and flexible debt, to go buy that asset while your money remains intact and grows tax-free. So that is really the cycle that I run there. And comparing that to what I was doing before, like I mentioned, I was just using a high yield savings account and bonds. So before with that, every time I would save up to a down payment, let's say it's 50K, I'd go back down to zero. There is no leverage. And more on top of that, you're taxed the entire time. So you're like a dog chasing its tail. With this strategy, it allows you to capture those down payments. You capture those down payments and apply leverage and effective tax planning to go buy your assets. And one question that really comes up that I want to hit on is the cost of insurance. And we have to be very clear about that too, right? If I put in 170 and only have access to 150, that's a 20K delta. That's serious. You have to look at that cost of insurance, but you have to be cognizant on what that cost gives you. It gives you protection, a guaranteed rate of return. A lot of things can't guarantee you that. What happens if we invade Iran next week, which could happen? That could tank your stock portfolio. These companies have paid dividends through the Civil War, World War I, and World War II. So having guarantees and protection is very important. Also, death benefit. It's great. It's not really my primary concern, but that death benefit is money that you don't have to save up to in your different government accounts, which is very important when we're talking passions and taking care of the next generation. So that's protection. The retirement benefits. Remember, all the growth inside that policy is tax-free. And there's no red tape like there is with different government accounts. And then finally, you have that leverage benefit too. You have the capability to leverage your money to go buy assets while your money remains intact. So yes, there is a cost of insurance, but when you think long-term, past 3 years, the efficiency just gets blown out of the water. And then with the remaining time, I really want to get slick here and talk about some more advanced moves you could do, combining the world of real estate with these policies. So you could do cash out refis or partial 1031s and use these policies as a net to capture capital and help you scale way quicker. Let's say we have a property with 300K in equity, right? Instead of doing a cash out refi and going straight into the next property, you could take that 300K, use it and capture it inside this policy. So now it's working for you now, and then immediately leverage and go buy that next deal. Some things you have to consider when we're talking reality in the world of real estate. If you're trying to do a cash out refi and go buy that next deal, that equity is not giving you a rate of return, right away, just sitting there. It's inside of that deal. But what happens if you can't cash out refi again? What happens if you can't sell? What happens if you can't 1031? This allows you to capture that capital now, start earning inside the policy while you still go buy that same asset. So you duplicate those dollars. It's working and earning for you now while still being in your next deal. So again, you could get really slick doing cash out refis or partial 1031s and use these things as nets to help scale your real estate portfolio. And the last thing I'll end with is this. This is just one design. This is a very, we'll call it bare bones design. You could implement these with businesses too. And get this, the contract premium could be a tax write-off. So if you're a business, you could lower your tax liability with the money that you're putting in, potentially bring you below and get you back into QBI threshold. So it's another 20% savings on top of that, while you still have all the different whole life benefits that we talked about. So there is some incredible tax plays that you could do both on the individual investor side and on the business side too. So pretty crazy things. I'll end it with that for any questions. And I'll be very respectful of your time. I don't want to go over budget, but that's what I got.